there's a confluence of factors in my mind that are going on here that are causing the malaise that we see. One is that the Federal Reserve monetary policy in the U.S. is changing. The second is the Chinese economy is clearly slowing down. But the third, which I think, again, is not get enough press play, does not get enough attention, is this concept that many of the assets in the world are repressed, are artificially set because the supply-demand imbalance is so aggressive and perpetrated or implemented by governments. And so the outlet valve for volatility is not what it used to be. So the VIX going from 15% to 50% in a week is ridiculous, right? That cannot be explained by any fundamental shift in perceptions about the economic growth of China. I don't buy that at all. Cannot be. So it has to be a panic. It has to be a release valve. It has to be an overreaction by investors to the environment that we're in, but also not allowing for the natural kind of buffers to exhibit themselves, which is part of the reason why I believe that interest rates, particularly risk-free interest rates, have not moved as much as they have. We look at assets that we think are not repressed by the world's financial markets and that are also going to hit that more traditional 5% return target. And in our mind, there are two asset classes that just stand out as being overdone. The first you will luckily hear is emerging markets. So the local EM index, which has a passive, is the iShare that trades on the London Stock Exchange, has a yield of about 7%. That index is down 15% on the year. Now 10% of it is in Brazil. But that kind of return in an environment that we're in, I think, is incredibly attractive. Remember, we're not talking about monetary policy in the U.S. going from 0 to 5% in a year. We're talking about a very gradual increase, which would make that kind of asset class very attractive. The second is the high yield market. So if you look at the high yield market, it has a yield of about 7%. But more importantly, if you look at the CCC part, so the lowest rated part of the high yield market, that has a yield of about 12%. There are a number of issuers and companies in that index that we think are attractive, even taking into account the fall in commodity prices.